with their tax reform plan, but Democrats not so happy. They're already blasting that proposal.
All right, so here to break down what exactly is in the plan, Craig Bolanos. He's the CEO and founder of Wealth Management Group, Inverness. Good morning to you. Thanks for being here.
Absolutely.
Let's start with the brackets, because this can be confusing. I believe we had 7, and they're talking about 4, right?
We went from 7 to 4. Originally, we were promised 3, but it's definitely changed. So what I think people want to know is where are they going to fall?
Right.
So on that first $90,000 for a married couple, we're talking about 12% right now, as opposed to a blended rate that was between 10 and 15.
Okay.
Once you get above 90,000, now we're talking about moving into the 25% bracket for married couples. Once you get up to 260,000 above, now we're talking 35, and then the newest bracket, the so-called 4th bracket we've all been waiting to see, that's going to be for married couples above $1 million. So I know what you're wondering. Where am I at if I'm single?
Right.
Cut those numbers in half, and that's where you're going to fall.
Okay. So there's also some changes in the deductions, right? Or the tax credit, right?
Well, that's the whole genesis of this thing, is what we're doing is right now 70% of America takes the standard deduction. They want to move the needle so that more people can file a simplified return, a.k.a. not itemized. And the way they do that is they take that standard deduction and literally double it. We're talking $12,000 for a single filer, $24,000 for a couple that's married.
Yeah, we saw Paul Ryan holding up what looked to be something that looked like a postcard. He says, this is ideally what we want to see, you know, total simplification when it comes to filing. A couple things that stood out for me personally is that child tax credit going from $1,000 to $1,600. That seems like a pretty big leap.
Well, I think that's a big leap, and that's part of the focus on saying we're going to help working class middle America, because they went further. It wasn't just the child tax credit going from $1,000 to $1,600. It was the addition of 2 additional credits for a, say you care for a neighbor's child, say you care for someone who you don't claim as a dependent on your tax return, you're going to get a credit for that, in addition to a credit when you care for an aging parent.
Well, I think the concern for a lot of people here in Illinois and in Cook County is the high amount of Cook County property taxes that so many people pay. And so that's going to be, that's not really factored into this whole thing. And there are states just like us, like New York and other ones, that they don't like this.
I think that's the headline risk. I think everybody is waking up in America today and everyone says, what about me? And if you live in a high state tax, right, like Illinois, 5%, California, 13%, New York, up to 7%, you did just lose. If you pay high county taxes, i.e. real estate taxes, I mean, think about this. DuPage County, 58,000 homes have more than $10,000 a year in property taxes. All those people are going to be losing out.
And they're not the only losers. Quickly, students, this passes, they lose the deduction on their student loan interest payments. Also, charities could lose as well, right?
Well, I think you're right. Students are going to lose that $2,500 student loan deduction, and charities are worried because if more people no longer itemize, they might lose some of the incentive to give at the margins, and that's a risk for your local charity.
Oh, thank you, Mr. Bolanos, for coming in and explaining that, breaking it down for us. I appreciate that.
Absolutely.
All right.